So you've decided on a trading strategy that's going to be the trading strategy you use moving forward. You wait for the right setup and the right trigger to take your trade. All your rules are met, and so you enter the trade, placing your entry order, your stop loss, and your take profit. A few moments later, the trade starts going your way, your confidence is increasing, and you start to feel joy that your strategy is making you money. But then you check your exchange that you placed your trade on and realize one thing: the trade pulled back before it went the way you predicted, and that pullback hit your stop loss, and you were exited from the trade at a loss before it even had the chance to hit your take profit. The reason this happens is because when placing stop losses, most traders believe that placing a tight stop loss means they will lose less if they're wrong. But not only does a thought like this show you don't understand risk management, it also shows that you don't really know how to place a stop loss correctly. You see, a stop loss is not designed to take you out of a trade with less of a dollar loss if the trade doesn't go your way. A stop loss intention is only to take you out of your trade if your initial trade idea becomes invalidated after entering. For that reason, you need to delete the thought of a tight stop loss, and you need to replace this with my stop loss goes where it needs to be. Let's listen to an actual market maker about why this is so important.
Institutional traders will buy at the level. Now, most traders will put their stop loss a tick under the last low, and they will invariably put their stop loss at exactly where the institutional orders are. They will say to themselves, well, we know pretty sure that most of the stops will all be crowded around this obvious level. So they will bid the market at that particular level. All you need is one person to chicken out, and the markets are going to go where the bids are, and all those people will be taken out.
How do you know where it needs to be? Well, whilst you hit that like button and subscribe if you're not already subscribed, I'll explain this in more detail. Regardless of the trading strategy you use, whether it's the TBD system that we teach over here at Trade Travel Chill, which by the way, the link is in the description of this video if you want to check out how to get access to all of our courses, community and daily live sessions, or you're a traditional technical analyst, you need to understand the concept of a peak formation and trapped traders. After all, no matter what strategy you use, for the most part, we're all trying to profit from price moving in a trend, either a trend to the upside where we will open a long position, or a trend to the downside where we will open a short position. Our goal as traders is to identify when that trend is about to change to either open a new trade or to take profit on an existing one. In order to identify this, you must be aware of two things. Before trend changes, there is usually one thing that happens, and that thing is called a peak formation. This is the first thing you need to be aware of. In an uptrend, it's a peak formation high. In a downtrend, it's a peak formation low. That peak formation will often trap traders, which is the second concept you need to know. So what is trapping traders and why does it happen? You see, when we trade any market, there's always someone trading against us, and that entity is known as the market maker. If we're long, they're short, and vice versa. This has to happen because without a buyer, seller's orders cannot get filled. And without a seller, the buyer's orders cannot get filled. This is the market maker's job, and this is what keeps markets moving. When a trader uses leverage, they are partially borrowing funds from a market maker. So when price is trending one way, the market maker is lending, and eventually they need to take all of that back. And they do this by issuing a trend reversal and essentially liquidating all the traders who borrowed funds. But the step before liquidation is where the trap happens. The market maker needs to keep traders in an open position before they can reverse the trend. Otherwise, they don't get to liquidate and collect back their funds. The trap traders essentially become the traders that open their trade in the wrong direction at the very end of that trend, the peak formation. So by now you're probably wondering, why is Annii telling me all of this? I just want to know where to place my stop loss. Well, here's why. Let's think about this logically. If we now know that a peak formation is where the market maker traps retail traders, then by default, that means if price were to return to that area, those trap traders would be released. Why would the market maker trap traders just to release them? You're right, they wouldn't. And therefore, logically, the best place to put your stop loss is going to be clear of the trapped traders as we're making the assumption the market maker is not going to allow price to return to that area. So let's go through some examples of this. So using this example right here, we can see that this is the peak formation low, and we can identify that the trapped traders are in this wick right here. And the reason we believe that is because price has not returned there. So once we believe that the peak formation is in, that means that we are safe to enter a trade, and our stop loss needs to go under the trapped traders in the case of a long position, because we make the assumption that the market maker will not let price return there. As far as a target, you can look to the other side to see where were the last trapped traders, as it is likely that once the trend changes, that is when they will return to that zone. By that stage, those traders are already liquidated anyway. So we have this area here, which we can identify as the prior peak formation high, and that would be our prior trapped traders. So for this trade, we can try to run our target up to that area, and we always front run that a little bit just to make sure that we get our take profit and we don't fall short by a few dollars. So in this case, you can see here that this trade would have hit your take profit before it came back down eventually to the stop loss area. Now, a very common mistake that people make is that they believe when they use the risk to reward tool on TradingView that this number down here is how much of their account that they will lose if the trade goes against them. So you can see here in brackets, it says 0.96. This is actually incorrect. What you need to be paying attention to on this tool is the risk to reward ratio. When you see a number next to that, in this case, we have 6.74. What this is telling us is that whatever I'm risking in this trade, should it go against me, I will receive 6.74 times that amount as my reward if it hits my take profit. So my job as a trader, and you need to do this for every single trade, is you need to be able to calculate if the trade goes against you, you will only lose 1% of your entire trading account per trade. To give you an example, if I didn't enter the trade here, and let's just say I decided to enter around here instead, but I want a tight stop loss because I'm worried, and so I put my stop loss like this, you can see in a case like this, I would have been stopped out of this trade because I was of the belief that this number in brackets right here is what matters. That's incorrect. If my stop loss was where it needs to be below the peak formation, now you would believe that I'm going to lose 2.49% should the price reverse. Also incorrect. Regardless of what this percentage number is right here, you should always calculate your maximum loss to be no more than 1%. And nowadays, crypto exchanges make it very, very easy for you to calculate this. On most exchanges, you can do the calculation directly on the exchange. So I'm going to use this as an actual trade example, and I'm going to show you how to do this on Bing X. So we can see here that I want to enter my trade at 60,128. So I'm going to go to the Bing X exchange, and I'm going to hit the limit over here. Now I've got my leverage preset to isolated 10x leverage, but I'm just going to put in here the amount that I want to enter my trade at. Now the next thing I need to enter is my stop loss. So my stop loss here is at 59,572. Now I'm going to enter my stop loss here, and then I'm going to use this slider. And as I use this slider, pay attention to this number in red right here. You'll see it says when last price reaches 59572, it will trigger a market order and the estimated P&L will be minus, and there's the number. All I need to do is very basic math. My total account balance is up here. So that means whatever number is up here, I can only afford to lose 1% per trade if the trade goes against me. Therefore, if I have a 10,000 USDT account, I can afford to lose $100 per trade. So all I need to do is use this slider until it gets to around the 100 USDT mark. This is how to ensure that you'll only lose around 1% of your total trading balance should the trade go against you. And this is how you properly calculate your risk, as opposed to using the false narrative of the tight stop loss. So let me show you how to do this in the case place of a short position. In this example right here, we can see that price came from an uptrend. The trapped traders were formed at the peak formation high. There was a couple of attempts. So on any of these attempts, you could have opened a short position, and your stop loss, in order to be properly placed, needs to go above the trapped traders, which is above this candle here, as it was the highest candle that price has not returned to. For setting the target, you simply look left to see where the last traders were trapped in the opposite direction in the peak formation low, which is this candle right here. We had one attempt, another attempt, and we did not return to that zone. So anywhere in that area would be a really good take profit. And in this case, you now have a 5.8 to 1 risk to reward, meaning if you were to lose 1% if it went the wrong way, you would gain 5.8% if it goes the right way. So it's not about the percentage that price moves. If price were to drop, you can see it's only dropping by 3.3%, but that's just the price movement. That's actually got nothing to do with how much profit you make. So if you're looking for somewhere to trade on, check out BingX so you can follow the steps that I just showed you to place your trades. There is a link in the description that gets you a massive trading fee discount to BingX, as well as a few other exchanges. All the details how to activate the discount are in the description of this video. But what if you miss the peak formation and you see price is trending and you want to enter throughout the trend? This is where we can enter trade within a period of consolidation. And there's another way in that consolidation to know where the market maker is trapping traders before they continue the trend. Let me show you that. So when it comes to entering trades when a trend has already started, there are two things that are going to happen. One of them is price is going to go into consolidation, like you can see right here, before it does its next breakout. The other is it's going to retrace. So let's talk about the consolidation first. When price consolidates after it's created a trend, it's usually going to be magnetized to an EMA. And the EMA that it's usually magnetized to is either the 50 EMA or the 200. And the reason for that is because most algorithms these days are coded off either the 50 or the 200 EMA. And we know now that about 80% of all trading done on all markets worldwide nowadays is algorithmic trading. It's not actually humans anymore. So if the algorithms are using those EMAs, we should as well. So what we also know is that any time that price is consolidating, the market maker is accumulating. And they do that by trapping traders into trades in the wrong direction. And in this case, if we're in an uptrend, the direction would be to the downside. So you might ask yourself, why would anyone take a short if we're in an uptrend? Well, that could be because their trading strategy has them believe that this might be resistance, for example, and price is struggling to break above resistance and it's going to reverse soon. So you would have in consolidation some retail traders, according to their trading strategy, tell them that they should be opening shorts here, whereas other traders would use a trading strategy that tells them to trade the trend. But when you understand what the market maker is doing, which is accumulating contracts, then you need to be looking for where the market maker shows up. In a case like this, you want to use a combination of two things. Stop hunts within consolidation is one really good thing. It doesn't show up all the time, but look for them if they do. If they don't show up, you're looking for which EMA the price is respecting. In the case of an uptrend, you're looking for the EMA to be holding as support. In the case of a downtrend, you're looking for the EMA to be holding as resistance. So in this case, we can see very clearly that this blue EMA was holding as support. This is the 50 EMA. A number of times price returned there, and we can also see that traders would have been trapped here with that fast spike to the downside. That means when placing your stop loss, not only do you want it to clear the 50 EMA, but you also want to clear this attempt right here. So you could enter your trade anywhere in this consolidation after you see that stop hunt, because you know now what the market maker is trying to do, and it is likely that they won't return there. That's as far down as they're letting price go. So in any of these candles, you could enter your trade, and the correct place to put your stop loss will be under where you can see the trap. Now, the second way that you can enter a trade once a trend has already changed is to do it on a retracement. So in this case, we have the downtrend, we have the peak formation that formed, the trend broke out and changed, and now we're looking for a retracement to get back in. You will use a Fibonacci from your peak formation low up to where the breakout went, and you're going to line up your retracement back to either the 38, the 50 or the 61.8 fib, but usually you will line it up in combination with something else. So in this example, we can see that the something else in this case was the yellow EMA, which is the 200 EMA. That lines up with the 38 fib, but nothing really lines up with the 50 and nothing lines up with the 61.8. We can also see in this that price respected that 200 EMA many times. So in a case like this, you would assume that it would be safe to enter a long position anywhere above the 200 EMA on any of these candles in the consolidation, and your stop loss just needs to clear that 200 EMA because price has not returned there yet. And then again, you're just repeating the process by looking left for your last trapped traders, and that's how you set your target. And the reason that we want to use our take profit to the last trapped traders is because once the trend does change, it is likely that the price will return there. Those traders are far beyond liquidated. They were liquidated when the price fell away, but it always acts as a high volume zone when price does return there. We usually do see a rejection. So it's always in your best interest to have your take profit just a little bit below that zone to make sure that your take profit hits and the price doesn't actually get just a few dollars away and reverse before you can take your profit. So in a trade setup like this, we can see here that the stop loss is 0.65%. That's the irrelevant part because that's the part you have to calculate to equal 1%. And if you do that correctly, that means that you should make 4.7% of your total account balance should the price hit your take profit. In dollar terms, if we were to risk $100 on this trade, and it's regardless of leverage, but if we were to risk $100 on this trade, meaning if the price came down and hit my stop loss, I'm losing $100, then that means on the exact same trade, if it goes to my take profit instead, I should make $470. And I'm going to prove this to you using BingX right now. So I'm going to enter this time my stop loss, my entry, and I'm also going to enter my take profit and show you how that calculation works. So here you can see my entry, my stop loss, my take profit, and I have entered those all on the BingX exchange, and my 1% risk can only equal $100. So now if I move the slider, I'm still looking for this one down here to equal $100. So this is as close as I can get it. So if this trade goes against me, I will lose $100.20. But if it goes the right way and hits my take profit, I will make $472. And that $472 is here, the 4.72 risk to reward. So try this out and let me know if your win rate increases now that you know how to properly place your stop loss. And also let me know in the comments down below if you'd like a video similar to this on how to properly use leverage to make sure you don't become a victim of the market maker and get liquidated on your trades.